Hello and welcome to PQ Prime. I'm Hiral Daria. Joining us on the show today is Vijay Chopra from Enoch Ventures. Vijay, good morning and welcome to the show.
Good morning. How are you?
I'm good, thank you. Vijay, overall, a lot of movers and shakers, the markets are showing a pretty tepid move in today's session. One segment that is in focus is the AMCs, and this is on the back of the finance bill that will be tabled today, which is saying that the investment in mutual funds, where not more than 35% is invested in equity shares, will now deemed to be short-term capital gains. Now, this will apply to investments that are made on or after the 1st of April. However, the debt mutual funds which are held for more than 3 years will no longer enjoy indexation benefit, nor will it be eligible for 20% tax rate. Due to this, you have all the AMCs which are under pressure in today's session. What's the view that you hold?
Well, I think they would be under some pressure, and so would be the investing community. I remember very vividly that 2018 too, this kind of a thing happened with mutual funds, and some kind of tinkering happened. But again, too frequent tinkering with the tax bylaws is not that good. I think that the government should be wise enough to not to make too many changes, because we have seen an exodus of FIIs already, and whatever Indian market is holding is basis the domestic funds and the kind of interest, the retail participation which has happened in the last few years. So I think that overall markets are going to be in a tizzy. They already are confused because we have seen so much of negative news flow, from Adani to a war to inflation to high interest rates, and lately the Fed also increased 25 basis points in the interest rates, and they are saying that they are going to increase it further, maybe one or two times, I don't know. But yes, for sure, markets with such high inflation rates, banking especially is on tenterhooks. So when the finance part of the entire market is on tenterhooks, I think that markets are not going to give a major up move. So not I'm not very happy with this development. But yes, I think that market is going to absorb in a few days, and then we are going to move further. But yes, taxation is one thing which investors definitely look into. 2022 and 23 has been a complete washout. I don't think many funds have made major profits, and whatever was there, the debt mutual funds, again, taxation is happening. So overall, I think that these kinds of regular intervention in the taxation are not good for the markets.
Right. So that's overall from an investor perspective. How do you see it impacting the AMCs overall?
AMCs have been, in a damage. They've been damaged. I think almost a year and a half. I've not seen any of the good AMCs doing anything. Whether it's HDFC, UTI, ICICI, whatever. So I don't think any of the EMCs have performed, and this is going to put further pressure. In the budget, we have already damaged the insurance companies, wherein more than 5 lakhs of investment in life insurance was the tax benefit has gone away. So again, where will the people invest? So this is a big problem, that if the taxation is so high, and India, mind you, is one of the highly taxed countries, if not the highest. So I think that if they want to promote people investing in capital markets and not going the traditional ways, so taxation has to be investor friendly, and overtaxing is never good.
Right. So that's with regards to where AMCs go. Now, in contrary to this, the government is proposing to change tax implications for unit holders of REITs, InvITs in the Finance Bill 2023. And this is a proposal to soften the tax blow for the unit holders as well, right? So you see, in terms of the REITs as well as the REITs have opened in the positive. InvITs were pretty, flat when I last checked them out. What's your view, and do you think this is something which will promote investment in REITs and InvITs? And secondly, what would you advise and what would your pick be?
Well, I think that hardly any people are investing in REITs. So if you look at the total investment which has come in REITs and InvITs, it is very minuscule. And yes, the kind of focus the government has on the infrastructure. In this budget, they had a 10 lakh crore outlay for infrastructure. So for sure, it is going to push the infra space, and money coming into REITs and InvITs would definitely promote investments in this area. And yes, the money would be there for long term. So these companies can use the investor money in building roads and better transportation and so on and so forth. So I think this is a welcome move. I do not track much of REITs, neither have I
Hmm.
invested or so I think that I'll do my research, and next time whenever we meet, I'll bring up some research on this.
Absolutely, surely. Moving on, you have IT counters which are in focus as well, Vijay, because clearly, if you go to see post the Accenture numbers, today we've seen IT stocks which did open gap up. What's the sense that you pick up taking into consideration the guidance that Accenture has given out? Secondly, in terms of the performance, and thirdly, if you have to look at the layoffs that they're doing as well, what's the commentary that you pick up from there? And how would you actually, what would you advise investors to do with IT majors?
Here we have to understand how these IT companies function. They have a lot of bench strength. And when I say bench strength, so there were times when there was an overflow of major orders and the contracts which they won over the world, across the world, and they needed ad hoc manpower. So that's why they had a huge bench strength, whether it's TCS or any big IT company for that matter. So I think these layoffs overall, I think that these people might not be having that kind of a work. Number one, the order flow might be slow. Number two, which we are seeing since the war. And number three, there is a lot of deadwood which accumulates in any organization. So I think that organizations need to be smart. If I talk about the balance sheet, so if on the balance sheet it's going to be good. Because IT companies, the major expense is salaries, so that would make the balance sheet better. And I'm sure that as they gather steam and orders over a period of time, the hiring would start again. Number two, very important point. If you look at the entire IT industry in a totalitarian way, so most of the business, I think more than 50% of the business comes from the BFSI space. Now, BFSI has been in the eye of the storm for quite some time now, and we have seen banking, certain banks going bust, and the biggies like Credit Suisse also going that way. So we really don't know what's in the cupboard, and there might be skeletons falling out. There might be hundreds of banks, smaller banks, which might be taken over by bigger ones. So IT spends are going to take a break for some time, and that's why I think that because IT companies have a very clear guidance for next maybe 4 to 8 quarters. So looking at that guidance and looking at the
Hmm.
maybe that they do not have that kind of an order flow in the next year or so, so they are probably cutting down on their number of employees, and bench strength is being done away with. So I think that IT, the top IT companies can be accumulated maybe about 30-35% at this point of time. But again, wait, we might see some damage further, because the black clouds I don't see waning off.
Right. So that's with regards to our IT majors. So moving on, Vedanta has been in focus as well, and we know for all the reasons, specifically from a Vedanta resources perspective and the chatter with regards to Hind Zinc. Now, Vedanta is looking to consider a fifth interim dividend on the 28th of March. Right, as we know, even Hind Zinc has declared a dividend of 26 rupees per share. With all of this, how would you rate Vedanta currently with all the concerns it is facing? And would this be a buying opportunity, or would you advise investors who are invested in Vedanta to book profits?
Well, I think that over the last so many years, I've been watching this company, and very closely. I've been watching Mr. Anil Agarwal. So what he does is he pledges his entire stake at a very mouth-watering levels. You can get debt in the Western world about 2-3%. Now the rate has gone up to 5-6, but still better than India. So, and they are a heavily dividend paying company. It's not this year, but if you look at the trajectory in the last 15-20 years, they've been giving dividends in the tune of 20% plus. So I think that this is a good company. Hindustan Zinc, for that matter, is a better company than Vedanta if you look at from a balance sheet perspective as well, and portfolio perspective as well. Hindustan Zinc has a lot of good mines of zinc, and their zinc, let me tell you, all these mines are drying at the rate of 1 to 2% per annum. So all the metals are going to be dearer in the next few years, whether it's copper or zinc or all the industrial metals, so to say. We have seen a rally in silver, gold, copper, zinc, practically every metal. So I think that Vedanta is a good company, and there are fears around the pledging percentage, which the debt which Vedanta has raised. But again, I think they are secured by a lot of assets, and there are companies which do not have assets and only have valuation. So Vedanta's valuation is based on the real assets, mines they have, the businesses they have, and I think they have very good cash flows. So it is not an Adani case for sure. And if the company is giving dividends, I think that it's making decent profits. So Hindustan Zinc is my first choice, followed by Vedanta. So no need to panic in Vedanta's success.
Right. Moving on, Campus Activewear has been an interesting counter. The stock is slumped in trade on the large block deals that have happened. Market chatter is that TPG Global is likely to offload stake. What's your view on the company? Because overall, if you go to see, the stock is up around, I think, 15-17% since its IPO. How are you looking at the counter?
Well, for that matter, look at all the footwear companies, whether it's Campus or Bata. I think that if you want to be in the footwear space, be with Bata. Bata also has corrected quite a bit. And again, whenever you see you are expecting a recovery in the markets, be with the largest companies, even in IT, as I mentioned, be with TCS or an Infosys or an HCL Tech rather than being in the mid cap. So if you want to be in the footwear space, I think Bata is much better placed and a larger company and a bigger brand than Campus. So I would recommend that be with a Bata rather than a Campus.
Right. Moving on, HDFC Life as well as SBI Life, both these counters are trading under pressure. If you see SBI Life, almost a 10 to 11% decline is what we've seen on a YTD basis. Similarly, if you see in terms of HDFC Life, again, a 13 to 14% decline. So there has been underperformance that has been coming in from life insurance majors. What would your view be on this, number one? And two, taking the kind of correction that we've seen, are these good entry levels to look at the counters?
Well, I think that if you look at SBI Life or HDFC Life, we heard what happened in the budget, and since the budget day where it was trading about 1250, 1216, it just tanked, to levels of 1060 odd. So the reason was very clear that people investing more than 5 lakhs in life insurance policies won't get a tax benefit. So the chunky business comes from the bigger customers. So there's always a Pareto principle in place, the 80-20 rule. So all the big clients which used to invest maybe lakhs and lakhs of rupees in policies, and used to park their money for a safe 6-7% return over a period of time, that won't happen because the tax benefit has gone. Now, for the retail customers, over a period of time, these are good companies. It would take some time, but right now, I don't think either the chart technically or fundamentally one should get into these companies. So just wait for dust to settle down. Maybe another 6 months, and then probably these companies would have better strategies to reach out to retail customers. And India is a heavily underinsured country, mind you. So these insurance companies would have strategies, and they would have better penetration, and I'm sure these would be able to weather the storm.
Right. And very lastly, let's pick up the Bajaj twins as well. Absolute underperformance coming in the last, say, 4 to 6 months. From a valuation perspective and from a business perspective, what would your advice be?
Well, it's a wonderful business, both the Bajaj twins, finance and FinCorp. But I think that higher interest rates, they always propel a fear of defaults. So that's the reason why banks are not performing. That's the reason why we don't see even an SBI or an ICICI or a Kotak or a IndusInd Bank not performing. So there is an impending fear. Until and unless we see high interest rates coming down, the banking industry, the NBFC industry, or the companies like Bajaj Finance or Bajaj Finserv, these will take time. But yes, these are beautiful businesses. They have very high penetration, across the country. But I would wait to get into these stocks, and let the interest rates either plateau. Let the RBI governor say that this is the last increase we are doing, or we are going to decrease from here. I think that I would be a buyer, and I would recommend to get invested in these companies heavily. But let that day come first.
Right. So I think that's something we need to wait and watch as well. Thank you, Vijay, so much for joining us on the show and giving us those views. But clearly, market's not really doing much, though we've maintained to stay above the 17,000 mark. We did hit a low of 16,994 in intraday trades so far in the last 1.5 hour. But clearly, it seems to be a day of consolidation, tepid move. However, for the week, we will end in the negative as well. That's what we are picking up so far. Thank you. Stay safe and speak to you soon again.